Hey everybody, welcome to Trading Capital's exclusive daily analysis of the stock market. Today is currently March the 15th, and as we digest the price action today and the economic data, there's lots to discuss. In this video, today we're going to be specifically talking about natural gas, oil. There's some important price action that is unfolding in the energy market that everybody needs to be aware of, not only from an investment standpoint, but from a consumer standpoint as well. We're also going to be touching base on the S&P 500, the two-year yield market, and what that is telling us and showing us, and why we need to understand what comes next in this cycle. Obviously, we'll discuss the tremendous amount of negative news that Credit Suisse received today. And finally, we're going to be discussing the economic data that we received today and what we're also looking for tomorrow, and the implications for the investment landscape and the overall global economy. All right, so jumping into the economic data, as you can see today, we received a whole host of information. Core retail sales came in line with expectations, at least the month-over-month data did. The PPI over here came in better than expected. It's showing that the producer price inflation is actually decreasing. That is a good thing because that typically leads the CPI reading next month. So the fact that producer price inflation is now declining, or at least seems to be this month, maybe we are going to see more of a harder dip in the overall inflation rate in the near months to come, which would obviously be an important thing from the consumer side. Now, looking at these retail sales over here, this one actually came in a little bit worse than expected. So that is not positive for the economy, because certainly retail sales are starting to slip as of late. We went from booming to now possibly contracting. We'll just have to continue to monitor it month to month. But overall, today's data was pretty important. It is giving us glimpses into what is happening. There was also another point that we don't have on here, but it was the Empire State Manufacturing. It took a whopping decline. The market consensus was roughly to come in by a minus 8% contraction, and it came in minus 24, almost a 300% miss on the market consensus for the New York Empire State Manufacturing. And why is that important to know? Because it follows up tomorrow's economic data, and this was today's. Consensus was minus 8, and it came in at minus 24.6. So that is horrifically terrible for the overall economy. And that's why you saw industrials like Caterpillar get smoked, the XLI down substantially. And actually the XLI was one of the worst performing sectors today, just behind a few other ones. Now, jumping into tomorrow's data. So basically we're looking at a few things. Building permits, that's going to be crucial. Is the housing market and the home builder side starting to slow down? Certainly we had earnings from Lennar, which the market took well, but that is pretty much closed flat before where it was trading prior to earnings. Some of the guidance that Lennar gave as a home builder company, I don't really agree with it, considering when you look at the reflection of mortgage applications declining at a rapid pace. I don't know how they're going to fulfill their forward guidance in the coming months. So that's certainly a little bit of an opportunity that I'm watching for on the home builder side. Now, building permits have a tendency to also spike yields depending on what transpires there, so keep an eye on that. The real important things, these 2 points here. Initial job loss claims. This is what the Fed is most likely going to be looking at most, because they truly believe a hot labor market is going to really contribute to that underlying inflation and that sticky inflation. Wage growth and wage inflation is very, very sticky for the economy. It's not what the Fed wants to see. So keep your eye on that specific number at 8:30. And then the Philadelphia Fed manufacturing is also extremely important. Look at this forecast, minus 15.6. The manufacturing sector is a leading indicator for the overall economy. And it is going to be crucial because it'll identify to us if this economy is actually starting to slip lower and lower. And like I said, it's a leading indicator. You might hear analysts saying, but GDP growth is strong, this and that. But I truly believe from economic cycles that the manufacturing data often is a leading indicator for many of the earnings, the company's earnings in the stock market. If we go through an earnings compression, that's going to be bad for investments and the overall stock market. And that's what I'm kind of forecasting. We could slip into an earnings recession. Now, it won't be the whole market. There's going to be a certainly stock pickers market out here. There will be positive strengths in the market and tons of opportunity. But there's certainly a lot of companies more vulnerable than others. And I do think we're going to start to see that in the breadth of the overall market. So certainly, if those economic indicators start to slip deeper and deeper, it's going to be negative for our overall stock market picture and the economy moving forward. Obviously, everything can change if the banks start up QE again, but until we really start to see immense QE and more so from the fiscal side, that's going to be the optimum, the tailwind that lifts these markets higher. But as of now, it's looking bleak. But again, we'll have to interpret the data as it comes. Now, jumping into the charts, there are a couple trade signals our members got. I've been touching base on natural gas for quite a long time now, and it's finally time for another free complimentary video on natural gas. Full disclosure, I am long natural gas as of today, and I plan to build and accumulate a position. This can be a position in terms of my portfolio for the long term and a swing trade opportunity. But natural gas has now fulfilled a beautiful consolidation period. I went long via the UNG. My members received the trade alert this morning or this afternoon. We were very, very patient. Many people hopped in here, thought nat gas was done. Nat gas came and dipped back down, made a new low in UNG. We went long at 791, full disclosure. And I would hope to see it go lower because it just means I can start accumulating and building a bigger position, because I think natural gas has put in a cycle bottom. I think we could see natural gas at 15 bucks in probably a year or two. And again, it could go even higher than that. I mean, UNG 15 bucks. I think the natural gas price could easily hit, $8 to $10 easily over the coming years. And that's why we're going long. That's why we're building a position. So I just wanted to give some full disclosure there. Now, in terms of oil, oil has had some negative price action. We've been touching base on oil in a few of our videos, which is the reason we were actually short a few energy stocks. Now, oil has had a technical breakdown, and it's very negative for the overall energy complex to see oil cracking these key levels. Great for a consumer side. We're all going to get cheaper gas here in North America, but definitely bad for the XLE and energy complex for oil to be breaking down. Now, oil breaking down is good to reduce inflation, so that's obviously going to help. We'll have to continue to monitor the oil price because it could be reflected. This breakdown and weakening in price will contribute to a decline in energy if oil stays at these levels. Basically, we've been touching base on the $66 level as near-term support. Look what level we hit basically today to a T. We've been prepping our members. We've even given this level out in free videos, and oil found some near-term support. Oil's not going to fall down in a straight line unless we have some catastrophic global deflationary event, which I just don't have any signals as of yet, but things can change on a day-to-day basis. Certainly we're seeing that in the yield market. But there's a new price target on oil. Now with this technical breakdown, there is a brand new price target on oil. I'm not giving it out as of yet. Even my members don't have it yet. My members will be getting the oil price target first before anybody else. But as of now, I'm holding that to my chest. One thing I will say, it's lower. It's actually quite substantially lower. And many people will disagree with that, but this is the beautiful thing that makes a market. I don't want everyone to agree with me. I would like to hear people challenge me. And if they do, take the trade on the other side, because that's what makes this market, and that allows us to either profit or not. Numbers don't lie. Certainly performance speaks for itself, and we here at Trading Capital have an outstanding track record since launching the service, and we plan to continue to thrive for our members. Now, since we've discussed the energy market as a whole, we're going to be touching base on the S&P 500. A quick little analysis here. The S&P was down again 0.63%. Why? Big bank weakness. When you compare it to the NASDAQ tech-heavy sector, that was actually up when the Russell was also down. So 2 out of the 3 indices were down. But when you actually factor it in, technology has a higher weighting than all of the other sectors with the least amount of stocks. So it actually doesn't really show the true degree of breadth of this market. The S&P 500 was down, the Russell 2000 was down, and the NASDAQ 100 was up. 100 stocks have basically been insulating this market decline, and it's going to be really, really interesting to see if technology comes under any pressure. Now, in the near term, I think the S&P could actually get a bounce, barring there's no more other bank blowups. So definitely we were able to close 16 trades today with our member alert service 14 of those were winners, 2 were losers. Everyone has their losers, but massive profits with trading capital today. And one of the reasons why we close so many trades is because you're starting to see sentiment turn extra bearish. And yes, I think there's more downside. None of this is financial advice, but I do think there's more downside in this market. However, the timing is critical. Before the downside in the short term happens, I think we get a little bit more of a higher retrace to suck people in. Keep in mind, this Friday is options expiration, with many bulls now turning bearish and dumping their positions and going on the short side. Think about it from a market standpoint. Where do market makers stand to gain the most amount of money? When we think about there's 3 to 4 trillion expiring in options this on Friday, I don't have the final numbers yet, but trillions of dollars are expiring on Friday. And if the market is more swayed on one side, betting on these bank blowups, everyone's getting short on these banks, blah, 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 market makers could rip this up, cause that max pain, option loss, and then let the trend resume. But the volume on the markets have been exceptionally high as of late, which is showing that, you know what, we've been seeing the volume in a downtrend, which is kind of a little bit of an indicator that this downtrend is likely to resume. But again, with the incentive of trillions of dollars on the line, market price action can be manipulated, which is why I think we should see extra volatility coming up into this Thursday and Friday session. All right, so now since we've touched base on the SPY and where I think we can get a retrace to is these areas over here, let's look at the 2-year yield and really try to break down the implications of what the 2-year yield and the movement in the Treasury market is doing. And one of the reasons our markets have been so crazy volatile in the recent trading sessions, if you simply look at these, this is a straight waterfall collapse in the 2-year yield. You can see we're still holding this bullish pattern. You tried having a little bounce, that was rejected again. It's going to be really interesting to see the price action, because as of now, the bond market is pricing in about a 60 basis point cut in the Fed fund rate. So the Federal Reserve has the Fed fund rate at 4.5%. You can see on the chart right about this wick high over here. The bond market and the market is now saying the Fed is going to cut. So realistically, there's a couple scenarios that could play out here. We get the rate hike near the end of the month from the Fed. Tomorrow is the ECB. So I think that's going to be prudent to watch, because if the ECB softens because of this Credit Suisse contagion in the market, then we could really start to see the dollar explode higher under a softer potential ECB. And I'm going to touch base on Credit Suisse a little bit more, but overall the 2-year yield, if the bond market has this mispriced and the Fed actually does raise rates or even pauses, there's still a huge discrepancy to where they're keeping their Fed fund rate at 4.5 and where the 2 years, which implies the 2-year yield has to adjust higher. The bond market right now is just front-running the Fed, front-running the Powell pivot. They could be right, but if they're not right, they will get massacred. And I say that again, massacred with a capital M, with an exclamation mark. Because if rates adjust to the Fed, and if the Fed does do a quarter basis point hike just to really stick it to them and say, you know what, we're serious about this inflation battle. The PPI is down ticking, but the CPI month over month went up, so we're not happy with that. Maybe initial job loss claim come in higher than expected tomorrow, and the labor market's still remaining strong. Ultimately, I believe the Fed up until I hear it from their mouth. Yes, the markets can front run, which is why you've seen a tech rally from the yield softening substantially. Imagine if the end of March, the Fed sticks to the 4.5 or actually raises yet again in a market that is so fragile. You would see the NASDAQ and tech get slammed. I'm telling you, the NASDAQ has been ripping higher. Tech has been loving these rates because cost of capital is going down. But anybody that wants to know the economic cycle, I save that for my members. I am going to encourage you, please study the economics of how the rate hike cycle works and what it means when we're hiking rates, and then when we come off of the peak of rates, and then when rates get lowered and cuts get lowered and lowered and lowered. It's very critical to know, especially if you're playing with your money in the stock market or any type of investment, whether it's housing, bonds, stocks, equities, whatever it may be. It's prudent to educate yourself, and that's what we try to do here with our members. Now, I'm going to touch base on Credit Suisse because we all probably heard the news. Credit Suisse, massive, massive blow up. According to the news, according to the Saudi fund potentially pulling back on some of their investments and no longer providing future capital. One thing's for sure, this was all over. The price action was telling us that there was issues at Credit Suisse. These issues started long ago. These issues started way long ago when you started seeing these massive sell-side programs, gap downs, almost like this stair step down. Consolidation, break. Bearish consolidation, break. Bearish consolidation, break. And you finally got the hit of this news. And not only were these, but you had Credit Suisse default swaps, credit spreads blowing out, which was a signal from the bond market that this company is junk. There was pricing in so much risk. And that's what we've seen. We saw at the lows, Credit Suisse was down almost 30%. Now, this is a hallmark bank in Switzerland, in Europe. It is well known. It's roughly, I believe, it's 4 times bigger than the Silicon Valley Bank. And I stand to suggest it actually has a lot more derivative exposure than the Silicon Valley Bank. And that's typically the derivatives are off the books. Not many people talk about that. But Credit Suisse is a global, well-known bank. And for it to go down, I don't think that happens. I think they backstop it, which is what they have been saying, borrowing money. But what that's going to do, if you really think about this, and what I think the grand master plan may be of the Federal Reserve, the Fed knows that some U.S. banks are going to fall under these rates. But I think they know that the rest of the world are going to have more bank complications and defaults than anything in North America. And I think that is going to help only strengthen the US. It's going to have a flood of money into the US dollar, exiting Europe, exiting Asia, exiting Japan. Who's next? I think this year we will have a bank default and several bank defaults across the world. From every single continent, I think we will hear about bank defaults. And it just started in the US, but I think that was just the start. And I think the defaults in outside of the US are going to be worse, which will strengthen the money as capital flows into a safer economy like the US, like the DXY, like the UUP. And that is not going to bode well for assets. But if you really think about it, the US is flexing their dollar muscle once and again. And we haven't seen this for a long time. Everyone's been so used to low rates. Everyone has been so used to an easy money United States. And I think we will see that again. But I think this time might be slightly different where there's a master plan that there's a financial war going on around the world and the Fed and the US is there to save themselves at the end of the day. They need to deal with inflation internally before they can help anybody else out. And I think for them to help themselves out, they have to hurt others. That's how this is going. And if we really see money flowing outside of worldwide markets and into the US, that would strengthen the dollar, that would export inflation out again, and it would basically cripple other economies. But that's how the tactics of the world reserve currency over historic cycles have worked and the sophistication of using it as a financial weapon. And that's why we're seeing countries trying to get off of it and out of it. But some countries are so dependent on the US that it's really difficult to get away from that grasp. Now, Credit Suisse did have a magnificent bounce off of the lows. This was over a 25% bounce. We were actually going to day trade in the live day trade room. We did call out this level to the streaming viewers there, but it just missed our level, but we were close to going long. But again, super high risk. Do I think some of this could have been an options X rumor by the Saudis? I do think so. I think that the Saudis have picked up on what Peter Thiel did to Silicon Valley Bank, and now there's a lot of influential people with tons and tons of capital in these institutions that at the blink of a comment, a statement release, can collapse important financial figures. At the end of the day, we all know the important banks are going to get bailed out. That's not even a question. There's not a question that intervention is going to happen. But the intervention doesn't happen before the stock plummets 30%. I mean, imagine if you have billions in there and you take an options contract or a short position or a long position and you plummet the stock. Think about how much you can gain. Think about that. And that's what the importance is that the stock market is becoming a news headline driven. I think powers that be, influential figures from all over the world are starting to recognize that the stock market is very news driven. and they're using and wielding their power through news and social media platforms. On that note, I'm going to thank you all for tuning in. I hope this video has been informative. If you've enjoyed this content, please like and share it as we're continuing to try to expand. And if you're interested in what we do here at Trading Capital, definitely check out our website at www.tradingcapital.ca. Thank you, everybody, and I wish you a great evening.